All right, in this lesson, we are shifting from strategy to execution. So how to actually place a trade in the futures market using the correct tools. You'll learn the difference between market, limit, and stop orders, how to place your entries and exit with intention, and how to manage risk using OCO brackets and stop losses. And whether you're trading breakouts, pullbacks, or momentum setups, proper execution is what separates a good idea from profitable trade. The goal is to teach you how to enter, manage, and exit futures trades with structure, control, and risk and discipline using the same tool professionals use every day. So, to start off, before placing a futures order, you have to choose the right order type, and that choice can affect your execution, your risk, and your fill quality. Let's start with the most basics. A market order. This means get me in immediately. It fills at the best available price, but that price can slip, especially during fast moves. You don't control price, you just control the speed. A limit order says only fill me in at this price or better. It gives you the control over the price, but there's no guarantee you'll get filled. The market may touch your price and keep moving without executing your order. A stop order becomes a market order once price reaches a trigger level. This is often used as a stop loss, but can also be used to enter if you want to catch a breakout. A stop limit order is more advanced. It triggers a limit order once price hits the stop, and it protects against bad fills, but it kind of like runs the risk of not filling at all in fast markets. Obviously, every order does have its own trade-offs. For instance, market, fast but less control. Limit is precise but uncertain. Stop is like a reactive. And then stop limit is controlled but slower. And the key is using the right tool for the right job, which we'll talk about in the next slides. So, entering a trade and execution strategy. So one of the biggest differences between amateur and professional future trader is how they enter a trade. The pros don't just go, oh, buy because it looks good. They don't do that. They plan their entry around the structure of the setup and use the right order type for the scenario. Let's break that down. So if you're trading a breakout and you want to catch momentum as it moves through resistance, you'd often place a stop order just above that resistance. Once price reaches it, your order fires and you're in. On the other hand, if you're trading a pullback setup, like buying near a support zone or view up, a limit order lets you get in that better price if the market pulls back into your zone. If the market's already moving fast and you see clear confirmation, a market order can work. You just got to understand you may get slippage, especially during volatile periods like news events. What you want to avoid is chasing prices, entering late after the move has already happened, and this is when where most traders lose money. That's why, to be a great trader, they map out their entry, stop, and target before placing any orders. You're not just trading price; you're trading the location and timing within a larger story, kind of. You could also ask yourself, is the momentum step setup or a pullback? Am I buying strength or buying value? Do I get a logical setup if this doesn't work? Answering those questions helps you not only enter smarter, but enter with intent, not emotion. Most beginners see stops as a safety net, kind of like they tell themselves, if this doesn't work, it'll just stop out. But better traders see stops as something much more than that. Your stop defines the entire trade idea. It tells you where your thesis is no longer valid. In futures, a stop order becomes a market order the moment it's hit, right? So in fast markets, you can get slippage, especially around big news or when liquidity thins out. That's why placement matters. You don't just want to throw a stop 5 points below your entry because it feels safe, right? If that level has no real structure behind it, no swing low, no view up, no fib level, no price reaction, it's likely to get tagged by normal market noise, right? The market doesn't just stay within a tiny little range. It will fluctuate up and down. So it could still touch your stop loss and take you out of the trade, even though your trade was right and eventually the stock will go up or down depending what you're betting. It's also worse putting stops just below obvious levels, such as support or recent lows, because it creates a common trap. Market makers know these areas that are stop heavy and often push prices through to sweep liquidity before reversing. Instead, what you could do is you could think structurally. Where would the market prove me wrong? Where would momentum actually shift? How much risk does that level require? And can my account handle it? Good stop placement is about combining all different things. You can combine technical structures, these are like swings, VWAPs, EMAs, volatility, how much does a market move on average, and context, time of day, upcoming news, economic conditions, and so on. And before you can place that trade, you could also ask yourself, well, where is my stop? Where is the dollar risk on this trade? How many contracts make sense with that stop size? If you can't answer all three, don't click buy or sell. The stop isn't afterthought, it's part of the plan. A lot of traders spend all their time thinking about the entry, but the exit is where you actually get paid. In futures trading, setting a profit target isn't just about what you hope to make. It's about what the chart gives you. That could be the prior high or low, the VWAP mean, a fib extension or measured move, a key volume, node, or price shelf. These levels act as natural profit-taking zones because other traders are watching them too. Now, in many cases, traders use OCO orders, which is one cancel other, and these link your target and stop so that when one gets hit, the other is automatically canceled. This makes execution cleaner and prevents accidental double fills. Profit taking doesn't have to be all or nothing. One strategy is to scale up. Take partial profits, a 1-to-1 or VWAP. Let the rest ride towards the trend target. Move stop to break even or when the risk is off. And this kind of helps you reduce emotional stress of do I stay or do I exit. It also gives you room to kind of capitalize on larger moves without sacrificing discipline. Most importantly, stay flexible. If momentum is fading, structure is breaking down, or the news cycle shift mid-trade, don't force it. The best exit comes from traders who aren't stubborn. They read the market in real time and adapt with ego. After all, the goal isn't to be right, it's to manage the trade well. So for this last one, we're kind of going to go through this example. You're going to have to visualize it because it's more like an example I built. It's not off a real thing that happened in the market. Like you won't see the chart. But let's just walk through it. So let's say we're trading ES, which is, if you remember, the S&P 500 E-mini, using a VWAP pullback setup. For entry, we're going to say price pulls back to VWAP after an uptrend and shows sign of holding. So I place a limit order slightly above VWAP, looking to get filled as price bounce. My stop loss, well, yeah, I will put it just below the recent structure low, around 4 points, because this protects me from deeper downside without hugging prices too tightly. My target in this case, well, it'll be I'm aiming for a retest of the session high. We'll say roughly about 8 points away. What this does is it gives me a 2-to-1 reward to risk ratio, meaning I'm risking 1 unit to make 2. Once I've decided the entry, stop, and target, I use an OCO bracket order. One order is my profit target, one is my stop loss, and whichever gets filled first cancels the other. As price moves in my favor, I actively manage risk. If price pushes 4 to 5 points in profit, I'll often move my stop to break even. I may also take partial profits at VWAP bands or mid-range to lock in gains. The process ensures I'm never improvising during a trade, and my plan is already on the screen, and my job is just to execute it. Good trade management isn't flashy, it's repeatable. It's about defining risk, planning exits, and letting the market do the work without letting emotions interfere. I hope this lesson, this short lesson, kind of taught you something. I know it's not really like a educational; it's more like a trading strategy video. 2 more lessons in this series. I hope you enjoyed this. Thank you.